Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. I am Sakar Cowley, and today I have the pleasure of having Josh Etingon from DXE Property Group. And Josh is based out of Long Island, New York. Their group has done multiple syndications. Their portfolio size right now is just about 30 million. And he, along with his partners, bring in a rich, varied experience from various different markets. So with that, Josh, welcome to the show. I appreciate your time today. Do you want to give us a brief background on how you got started, where you are with your company, Josh?
Sure. So firstly, thanks for having me. Excited to be here. I appreciate the invite. So so like you said, DXE Properties is my company. I'm the co-founder of it with one partner. I'll talk to my background mostly.
Sure.
My background's very much on the entrepreneurial side, whereas his is much more on the institutional side. So we brought that together, and we've been sort of actively scaling since then together.
Awesome.
But I started my first project was back in 2012. I was probably 25 at the time. And it was a 20-unit multifamily project in Cincinnati, Ohio. It was purchased for $175,000.
Awesome.
It's a pretty tough area, just in general. Its location. It was occupied by 4 tenants out of the 20. Just a complete disaster. It needed $200,000 worth of work. Just a scary deal to walk.
Mm-hmm.
But it was something that, we came into it. I had a confidence in my team out there, and gradually with some headaches and hair loss, we were able to turn the property around, stabilize it, and ended up selling it a couple years later.
Awesome. And if I may, Josh, on that deal that you bought, was there something like an off-market deal, on-market deal? What made you think, or was it more the price appeal that, hey, I'm getting 20 units for such a deep discount? Was that, more like the appeal around it?
So it was off-market. It was a short sale. I was connected to a property manager out there that we just connected well, and I think we were similar stages in our individual businesses, just getting going.
Sure.
So at the time it helped, but he sourced the project. We ended up paying him a wholesaler type fee. And more than anything, like every project, you definitely do make money on the buy, and we bought that one right. But that's been our focus really going forward, is trying to avoid competing with retail investors and finding a good story, off-market, compelling type project.
Sure. And I know, Josh, you have market experience from different locations and stuff. So I guess we will definitely get into the show in a little bit about it. Regarding your 20-unit first deal that you did, right? So it sounds like it was a distress sale. And what type of renovations you had to do? Like you said something about almost a couple of $100,000 worth of renovations into that asset. Could you maybe describe what sort of problems you had and how, what time frame it took to, sort of get everything going and increase the occupancy?
Yep, I can, and it's been a while, so don't hold me to the numbers. We sold it 5 years ago, but so. We needed new roofs. The parking lot needed to be completely redone. The balconies were deteriorating. Every unit needed, at a bare level, at a bare minimum, some level of renovation to make it livable, even the occupied ones, frankly.
Mhm.
Between that, if you $5,000 a unit in renovations, interior plus some of the roof, parking lot, balconies,
It adds up. It adds up.
It adds up pretty quickly. So even across a small deal, I mean, it was a big reno project for that size deal.
Sure, sure. How long did it take? Like 9 months to a year?
I'd say the physical side, we were able to do a lot quicker because it was so vacant. So we didn't have to worry about turnover or honoring leases or anything like that.
Mm-hmm.
In 6 months, we had the physical work completed.
Mm-hmm.
At least the vast majority of it completed.
Got it.
And we underwent a lease up, which was pretty successful. We definitely felt, some turnover because we leased up very quickly. I think everyone was really excited and feeling the pressure to lease up. And then we definitely felt a wave of just delinquency and having to flush out some of the worst tenants and retain the good ones, basically.
Right. And it's an awesome feeling that you're renovating and new leases are signing up, and you almost get excited that, hey, this is working. You see new tenants coming in. It's an awesome feeling. So I know you sold the building. So how could you maybe share some numbers as to how you make out on that?
Sure. So we were all into it for less than $400,000. And we ended up selling it for just over $5. I think it was $5 was the final number. When I went into that project, especially with when I was younger, the thought process was long term. Let's hold this forever. Cash flow, it'll be great. But the reality was, we created a lot of value in a pretty short period of time. It was one that would just be great to show end-to-end transactional success on. And frankly, it was in a more challenging submarket and neighborhood where really operating it consistently with that unit count was a challenge, frankly.
Right. Wasn't efficient at that point. And frankly, I mean, my experience has been, Josh, is that in these challenging neighborhoods, it's very difficult to operate and, achieve that scale, because just the neighborhood, bad actors and things like that, they take over. And it's just extremely difficult to, I mean, of course, if it's 100 unit where you control a lot more scale, that's one thing. But if you're having, under 30 units or something like that, it's very difficult to manage, have a staff and things like that. It just doesn't work out.
No, I mean, it's such a difference. The on-site staff, I mean, we won't look at a property that's less than 70 units on the multifamily side, because that's what we see as the minimum to be able to employ a full-time office manager and a full-time maintenance person.
Sure, I would agree. I would absolutely agree. So then, Josh, like how it involved, like how was your second deal, third deal? I know you've done several deals after that. Could you maybe share how you progressed through your different deals then?
Sure. Yeah. So we've done, it's actually about 12 projects total, which have varied from, I mean, multifamily is definitely the focus, but we have done a couple local, New York Metro projects. We've done retail and condo development as well on a smaller scale. But so next, looking back 2012, I next stepped up and stayed in the same market, just leveraged the same relationships there, did a 44-unit project, and then a 62-unit one also in the same metro area. And then after that, I left Cincinnati and did a couple projects in the Southeast, where I still own a few deals in Charleston in particular. But it's been gradual. I mean, every project has been gradually growing. I didn't jump from a $200,000 deal to a $7 million deal. It was a 200, this 20-unit deal, then a 44-unit deal, 62, 80, 96, and have just been gradually stepping up at a pace that is manageable.
Right. No, and that's awesome. I think based on your comfort zone and the capital and things like that, I think it's awesome to graduate slowly. Speaking of these different markets, then Josh, I know you're based out of Long Island. So which we all know is pretty expensive. And given your experience that you started, let's say in Cincinnati first, then you graduated towards, let's say, Charleston now in South Carolina. Could you maybe share like differences within these markets and what you think like investors should look for as they move around different markets?
Definitely. So yeah, maybe I'll first speak to the why behind me leaving Cincinnati, going elsewhere. I did professionally. I began working at as a software company, project manager there. After a few years, I said I want to get into real estate. I actually slashed my salary quite a bit to be a analyst and an acquisitions guy for a multifamily real estate investment firm, predominantly focused in the Southeast, garden style properties. So ultimately that was probably the best experience I could have possibly gotten from both the technical perspective and even more so from a relationship perspective, that I was really able to tap into a broker network that otherwise may not have given me real attention.
Sure.
On the market side, I was brought out to Cincinnati because of that one relationship with the property manager. And I almost worked backwards into appreciating the market of Cincinnati. I didn't really know it well, but what I like about it was that it is pretty diverse. There's 9 Fortune 500 companies there that are in different sectors. You have like a Procter and Gamble and a Fifth Third Bank, and you've just Kroger, I think, is also headquartered there. You just have a good diversity of employment and just good density. It's not the highest growth market necessarily when you compare to some of these Southeast markets or Southwest or Texas as an example.
Sure.
However, the cap rates tend to be higher and you're typically able to get a better yield and cash flow out of it as you hold the deal.
Sure. And how you would describe like Charleston maybe is different, like when you kind of studied the market?
So Charleston is one. It's definitely a smaller market. So the Charleston MSA is probably 800,000 people versus a few million in Cincinnati. What I love about Charleston is that it has like the landlocked nature of the New York metro area. So the growth could really only be in one direction, and it's sort of like a pizza pie. Charleston historically was tourism and military. That's what the economy.
Right.
But in the last 10 years or so, that's dramatically changed with Boeing has an enormous presence down there. Then you have Mercedes, Volvo, just large manufacturers that have really invested into the area and have completely transformed it. So that frankly is a lot of our focus. We just think that people are going to be leaving the Long Islands and headed down there, quality of life, affordability, all of those things.
Sure.
So we're willing to pay what could be perceived as a premium to be in some of those markets right now.
I see. So depending on your deal size there, Josh, like could you maybe give a sampling of, maybe one of your Charleston deals as to, how you found, what was the price and, sort of rent or value add components that you did. Could you maybe share some more information about them?
Sure. So just last year, 2018, about a year ago, we purchased a 80-unit property in a submarket of Charleston called Somerville. This was an off-market property, also sourced from one of our property managers in the market. And it was owned by the original developer's family still that built it in the 70s, believe it or not.
Wow.
Everyone loves that story. That
you love those, long ownership with a bunch of equity on their back, man. You always love it.
Yeah, so you just know it's a good story. It's just it was a challenging deal to do because the rents were extremely low. Average rents when we purchased it were $500, and the purchase price was $50,000 a unit.
Wow.
There was this extreme. It didn't have any debt cover ratio, or you were certainly not getting any type of agency debt. So this was a bridge debt play. We've owned it for a year. Average rents now are $750, and we're leasing units in the $850, $950 range.
Right. Just so that our listeners understand, the bridge debt would be, like distressed deals that would not qualify under Fannie Mae, Freddie Mac, and you're using that short-term bridge debt to, like renovate the unit, raise your occupancy up so that you can qualify for the agency debt. So going back to that deal there, Josh, how much was your occupancy? Like, what were the sort of the plays going on? Like, what was the situation there with that?
So there were a number of unique scenarios with this one. One thing I've never seen before across any of my own deals or working for a much larger company. So they were leasing units and having the person pay rent based on the day they moved in. So they could be collecting money on the 7th of the month, on the 12th of the month, on the 22nd of the month. It was crazy.
Wow. Talk about having a management nightmare.
So they were doing that. I don't know how they kept track of it.
Mm-hmm.
Everybody was on a month-to-month lease, but they were very, very well occupied. I mean, rents were so low. There was such a discount to the rest of the market that it was just constantly well occupied as we understood it. The financials were terrible. It was really just working off of tax returns because it was all handwritten by the owner's son.
Sure. You can tell low rents with all type of cycle of rent collection strategies, and you can just make up all the story that would go on. And so, but let's put it this way: the property wasn't optimized as it should be, and it wasn't professionally managed.
Yeah, and I bring up that deal because I think it speaks to the fact that right now prices are everyone talks about it. We're closer to here than we are here in the. But I fully believe and have always been a believer that wherever you are in the cycle, there's always going to be a good story and a good opportunity where you could buy into some value. It may take some work, but those stories absolutely always exist.
Right. Those stories are there, and I think what you touched upon is very important. And those stories, coupled with some deep value add, like whether it's deferred maintenance and things like that, or just like complete neglect or unprofessional property management, those stories exist throughout the board. And a lot of times, a lot of these assets, they really don't make out to, like, let's say LoopNet of the world, or they don't hit like sort of the broker's list. It's really off market relationship building, which sounds like I think we have done a lot. And once you know those, I think you just have to have that experience and muscle to say that, hey, we're going to see this project through. Because getting a bridge debt and going through that all those renovations, trying to get your occupancy up, it's a huge risk. Just trying to get through, and I'm sure you must be very relieved that once you got your occupancy up. Did you qualify? Did you say that you went agency debt route as well? Have you reached that spot now?
So not yet. We're locked into the loan for 18 months, so we can't finance until September.
I see. But I'm sure, like, once your occupancy is up, as soon as you'll.
Oh yeah, we're there on. I mean, we hit our average rent that we were projecting 6 months from now, so
Sure.
It'll be a good refinance.
Sure. Awesome. And I know, Josh, that you are syndicating these deals. Could you maybe give us an insight into how you're structuring your syndications? Like, how is your sort of split, any preferred returns involved and things like that?
Sure. So I've done a few different structures over the years and past syndications. The box that we sort of fall in right now is a preferred return with some level of split and then hurdle thereafter. So I'd say typically a 5 to 8% preferred return. And then we're either 90-10 or 80-20 after that. And at a 12 or a 14, there's a hurdle to 70-30 or 60-40, basically. That I gave you a range, but that's where all of our structures fall within right now.
Sure. So I guess, we all, I think, understand that depending on every asset, how the performance will look like, you have the sort of a general framework, and obviously each deal would be slightly different based on, how the numbers work out.
Certainly. I think, in this market, it's competitive. I do think the pref is meaningful, and I think investors appreciate it, and and I plan to offer a pref moving forward. Myself and partner are always investing in our projects, so we are earning on that side as well. But
sure. And I think it's very important, as you said, that you invest as a silent investor as well. You're not just, on the general partnership side, which, speaks to, hey, you're willing to invest in your own deals. So you align with your investors and you can sort of speak to it that, hey, we are with you in the same boat, basically.
Yeah, I've seen a lot of people just try starting, it's very, it's sexy to try to start this business, no money down, and you can scale it forever.
Sure.
At least I personally don't believe that's the reality. I think it is meant as a, get rich slow, gradual investing, legacy building, wealth building.
And absolutely, and I agree with you. And that's the whole model as to why, we give our podcast the premium cash flow award, is that you grow together, you do business ethically and with integrity, you align with your other passive investors, and we grow together, and what spreads out so quickly. Would you agree that hey, one person will refer it to their aunt or other friends, and suddenly you have off of one investor you probably have 3 or 5 investors who are coming together. And would you agree to that, Josh?
Yeah, I definitely would. I think this world, the syndication world, has become a little bit Wild West-ish, in that you have everyone in the world syndicating deals or syndicating for syndication.
Sure, sometimes it just seems too much.
Yeah. So, I do think to the passive investor, my advice would be just take your time and know ultimately who you're directly investing it with. I think that, to me, the most important part, because no one's going to sit down and know what you know or what I know from a forma perspective or knowing the deal itself. Sure. But they get to know the person and know that they're investing in that.
Absolutely. If I may ask those related questions around passive investors and syndications and things like that, there, Josh, when you go about raising capital, what are some avenues you have pursued, whether it's attending meetups and things like that, or if you're having those dinner table or coffee conversations with your passive investors, what sort of benefits you are sort of telling them? So basically kind of like going into more about how you're acquiring the passive investors and what benefits you sort of highlight them using your deals.
Sure. So look, it's gradual. It's very, very gradual. We sponsor a number of networking events on the real estate side, local RIAs. We've hosted joint meetups with other industry professionals. Obviously we're not talking about any deals at any of these events. We're really just trying to provide value,
Sure.
Inform people on the space, talk to the merits of, in this case, apartment investing.
Sure.
Depreciation benefits of scale, owning a slice of a bigger pie versus, a slice, whatever it may be.
I'm with you on that. Yes. Mm-hmm.
The residual nature of this type of investing, that it can be, and just really more than anything, the diversification benefits. I've done events, and one of my biggest supporters is someone that's a financial advisor for a large brokerage. And
that's awesome.
He loves everything about it. His company puts restrictions on what he can get involved in, but he's the first to refer people over to me, and it's interesting to see the amount of just faith that he has in this sector overall.
That is so true. That is so true. And one of the things I also like here in this, Josh, is that the business is so resilient. The multifamily or the apartment side of this is so resilient that, in fact, there's a statistic out there that during the crash there was such low delinquency across multifamily sector, and it was so important to highlight that what we actually did is on our website homepage, we have the entire bankers report where we kind of noted that, hey, in the multifamily sector, whether it was Freddie Mac, Fannie Mae, CMBS, life insurance, all these different classes that invest like literally billions of dollars, their delinquency rate was like 0.05, 0.03. So it was like, if you compare the scale and the amount of investment compared to what the delinquency was, it was really minuscule. And that's the fact on the ground, is that we know many investors, I know personally during actually the 09 and the 08 crash, that they really suffered in the in their house side of the single family world, versus a lot of investors who were in the multifamily, they in fact grew because the contraction or the price fall was really just more about fear and the markets. It wasn't a fundamental crash in terms of the numbers of multifamily. So a lot of investors, I'm sure you would agree to this, is that a lot of investors who bought properties during that 2009, 10, 11 era, boy, I mean, did they bought those properties at a deep discount? I mean, that is really,
Oh yeah, those properties have been resold three times since then.
Absolutely, and it speaks to the resiliency that I was highlighting there, Josh. Is that that fall was really just about fear and stuff. It wasn't about the fundamental vibrancy of the multifamily market itself. It was always good as it is. It was just just the market forces that caused the prices to drop off. Versus we should compare contrast with single family also. That in single family, for example, you had like bad loans and all these securitization notes and things like that literally went a precipice and took such a big fall. That was the real crash. But in multifamily, it was just fear-based,
Yeah, I mean, I think I agree with that generally. I think, even multifamily is not without risk.
Sure.
I tend to agree that, like, on the demographic side, there's going to be, you would think there's going to be demand in multifamily for a very, very long time. It's just, but whether it's need-based rental or lifestyle-based rental, there's endless statistics that just say lots of people at every level. But it would not shock me if there's some sort of a event or series of events that do put pressure on real estate, and particularly on the debt side, that does trickle down and affect valuations in real estate.
It does. You're absolutely right. In fact, we have commercial paper, like, those 5-year and 7-year cycle that start to mature. That's probably going to happen soon. And that's going to trickle down across commercial. I mean, in general, whether it's retail side or the multifamily side, you're going to see that softening. So I absolutely agree with you there. So anyway, so good. It's been an awesome discussion there, Josh. Speaking of syndications there, Josh, like how do you go about meeting different syndicators, or do you raise capital from like private equity firms and things like that? Would you maybe go into your strategies, like if you were presented a large deal, how would you approach that?
So it's been a consistent path of just building relationships. I drink a lot of coffee with a lot of people that I meet from some of these events that express interest. To your point, you mentioned it before, that my best referral is someone that's invested previously that then offers it to another friend of theirs and says, hey, I was in this and you should come along on the next one. The truth is, right now, when I pursue a project, I don't have a guarantee that we're going to have the equity lined up for it.
Sure.
It does become somewhat of a let's see what our investor base is interested in or not interested in, get it out there. And I mean, to this point, we've never fallen short on a capital raise. But it's pretty much first come, first serve base. I keep looking to my left because I have my list of, on a whiteboard, my
Your task. Yep.
But I wish I knew the answer. It's not a snap of the finger type of thing.
Sure.
But it's basically, we're not a huge company. It's two of us as the founders that are ultimately driving this.
Sure.
What we're doing, we're chasing deals and that have a compelling story, and at the same time nurturing both existing investors and creating relationships gradually with potential new ones. I mean, my largest investor is someone I met 6 years ago that had never invested with me, and finally, after 6 years, had this project and invested over $1 million.
Awesome.
So, it's truly, the way we look at it is there's no meeting not worth taking. It's just it's just a slow, gradual relationship building exercise.
Right. Awesome. That's awesome. Thank you. And I appreciate the bootstrapping, and I think sky's the limit for you, Josh, there. And, I wish you, an awesome luck. Please tell us, Josh, how, viewers can find you and how they can locate you in terms of your website and contact information and everything.
Sure. So we have a website, DXEProperties.com. Please do sign up for a newsletter there. We try to just share monthly updates of the market or progress of DXE and our journey. And then our contact information is on that website as well.
Awesome. Thank you, Josh. I appreciate your time today. It's been a pleasure. I look forward to having you back, as you progress and have more news. And I'm very much looking forward to, networking with you in future as well.
Me too. Great talking to you. Thank you.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.